Hello everybody, Peter here, Global Market Signals. I wanted to do a review of the seasonality aspects of gold and silver and maybe even the markets here. We'll take a look using seasonax.com. Fantastic website. We'll take a look at some things you can see here in terms of seasonality. We're going back 25 years. This is silver. I've removed 2008 as that was sort of a very strange period. You can see here on the chart that seasonality, the red line is where we are today. It's sort of sideways for silver over the last 25 years. But then if you take a period from December 21st to February 21st, so there's a very substantial trade coming up here in silver. And if you look at these numbers, they're very, very compelling. You look at the winning trades, 83% of the time winning trades. All right. You have 20 gaining periods, 4 losing periods in this time frame from December 21st to February 21st. So at some point here, it's potential for a nice entry in the next month and a half, 2 months. And we could have a very substantial rally in silver. After that, you can see if you go sort of February 21st and you go down into June, well, holy smokes, only 20% of your trades over the last 25 years are winning. If we do all the data and we go 50 years, it's a little bit better, but not that much. If you do just the last 15 years, it's still 20%. I mean, no matter how you cut it, that period post sort of mid or end of February becomes problematic, even if you take out the 2008 year. So really need to be cautious on what's going on here, but there is a trade coming in this, and it's certainly coming, and you need to kind of be paying attention to this, because I think it's going to be a great money-making opportunity. If we go into this period and we apply these dates, look at this. I mean, I just did the last 15 years, taking 2008 out, as 2008 was a crazy year. If I just run the period December 20th to February 21st, 85% of those trades are winning trades. Okay, you've had average annualized return 64%. You have some phenomenal. There's 12 winning periods, only 2 losing periods. What can I say? There's some good opportunities here. I think if you look at gold, boy, it's kind of the same sort of thing. If we do sort of, let's just do all the data, and we can add in all the years. Let's take out 2008. I'd like to take 2008 out as it's problematic. But I mean, if we take this period where we are today, the red line, to December the 16th, it's 50-50 whether it goes down or not, right? You have 24 gaining periods, 27 losing periods. Max loss was 18%. Max profit was 17%. What's critical to remember is once you get into this period and then you go out, and you go January, and let's take this out to mid-February again and apply these dates. With gold, it's a little bit stronger, but a little bit weaker than silver, but still pretty decent, right? You got 31 gaining periods, 20 losing periods, but your max profit is 46%. So you gotta keep that in mind. Very, very big potential for a rally going into the first quarter. If we go into equityclock.com and their gold future seasonality, I mean, once again, here, they're sort of, this is all data going back 20 years. End of October into that end of February, it's a good period for gold. So need to keep our eye on the ball. If we look at let's say the S&P 500, boy, if you run seasonality on S&P 500, I mean, yes, you can have sort of one little washout here, but holy smokes, from here into the end of the year, 78% winning trades, okay? If I take 2008 out, I mean, 2008 tends to skew the data a bit, but the percentages don't change, but the absolute returns may. If we do 70 years of data on the S&P 500, it's even stronger. I mean, there's a great probability that we get a rally in here, right? So have to keep your mind open. Maybe short-term weakness into the end of October. Any kind of weakness there, as I showed in the other charts, potential for buying and holding. Dow's the exact same. I mean, the Dow's even stronger, 81%. If I add in all the data, remove 2008. Yeah, we're still at 81%. So we're pretty good. I mean, if you run the election years on this, it's it's almost even better, right? So when people say, well, we've got, lots of problems and all this stuff going on with the virus and the lockdowns and the economy, I mean, fact of the matter is companies are knocking things out of the park. There was $1 trillion in personal savings before this whole COVID baloney hit, and that's estimated to be up to $6 trillion. You have a lot of cash on the sidelines, not just in personal savings. I'll show you the velocity of money, which continues to collapse. The personal savings rate has shot up. You're having phenomenal new home sales. I mean, new home sales, they're up. I mean, the high existing home sales were the highest since 2006. And the median house price made a new all-time year-over-year record high in the U.S. I mean, you keep having all of these things go up. You have the commodities starting to rise due to shortages of supplies. There's a lot of stuff going on, and the one thing that I think everybody's missing is the potentially that the upside could be the risk here, not the downside in the short term. Not saying past sort of the end of the year, but yes, you could have a quick, sudden, sharp correction in the market, which would probably be healthy. But I think if you just look at seasonality, certainly it plays into your favor. And if you look at the money printing and the stimulus package and the free money and it's just insane what's going on. So, just keep an eye on the ball, and remember to please subscribe to our YouTube channel, and we'll keep you updated on what's going on. Thanks for tuning in.